And please, you should not be able to make the same mistakes that some of us made at these formative stages in our careers, in our businesses. Now, when, for example, if, for example, you are to get, like, say, 10 million Kenya shillings today and you're in business, you get 10 million Kenya shillings today and you're in business. What do you think in this case here will very many people do? If they were to get 10 million Kenya shillings, most of you here, like right here now, you are 73. Most of you, I can guess with certainty, you will go home, do the mistake that most of us did. You'll go home and build a very good mansionette house, very big mansionette house, right? Which basically is a form of what here? Dead capital. All right? So is Mwalimu against people building in their rural homes? No. I'm really for that, because I know the repercussions of staying without a home totally at your rural area. You need some house. But should it be a 10 million house? Should it be a 10 million house? Someone talk to me. Should it be a 10 million house? No. I've seen some question there, but because I'm already live handling this on FB, I'll be able to address it there. All right. Later, now, ladies and gentlemen, in this case here, no, it doesn't have to be like that. It doesn't have to be a 10 million. You can do like a 2, because most of the capital that you are getting at this lower ages, at your lower age there, you should be investing most of it in where? In your business. You should really guard and control whatever money that comes your way towards your business. The same case even in Nairobi. Trust you me, when you go outside there, for example, to countries like Dubai, this thing of owning is not a major thing. There are very few people who own houses. So even in Nairobi, even if you're here, you don't need like a very, very big house, especially when you are in your early 30s, when you're trying to build yourself. You would rather, in this case here, channel all your funds, in this case here, to your business, and get your business, for example, paying, some rent for you. All right, until you hit some level. There is a level, of course, once you hit, you'll be having enough muscle now to be able to put up to own properties. But at your formative, when you're trying to form yourself, to develop yourself, let most of the income you get, in this case here, be channeled towards your business. Then that would mean that you'll not be having much to own these properties. What you'll be doing, in this case, is to do what is to lease. I've seen in this case here so many people who have a big urge of this owning. So what they do whenever they get little money is 800,000, they have a 50 by 100 land at Kamulu. When they get this amount here, in this case, they have something in Kitengela. Trust you me, at the end of the day, you may very easily become what here? Become illiquid. You may very easily become illiquid. And once you become illiquid in business, trust you me, some of those assets, try to sell them like today. If you are of an emergency, you will not be able to sell them totally. I have a friend of mine who has been trying to sell some land, and it's prime in some location here. And now this is like the 4th year. He has never been able to get what year? Any buyer. Even when he tries to sell it at half the price. I'm not against you guys getting those assets, but what I'm for today, given that most of you are trying to develop yourself today, please, let's, in this case here, strive to work with what we call leased assets. If, for example, today you go to Kajiado and you want to rear cattle, do you know that you can get huge tracts of land? All right? Not for owning, but just for leasing under a lease arrangement. So you'll get, in this case here, somebody who will give you his whole acre of land, and a lease arrangement for how much here? Somebody for 15,000, for example, per annum. And this is very close to Nairobi, Kajiado here, very close to Nairobi. 15,000 Kenya shillings a whole year. And remember, once you lease, especially if you lease long-term, like say 5 years, 10 years, those guys would even, allow you to fence it nicely as if it is what year? It is yours. And for sure, that land will be yours over the lease to what year? Over the leased period. So remember this acre of land, like if it is at Isinya, this acre of land, if you're to buy this acre of land, it will cost you, for example, like 2 million Kenya shillings. Now you can see now the balance. This, instead of putting this 2 million to this land, I would rather put 15,000 per annum. 15,000 per annum. And then the balance in this case, and I can put this balance into my business. I can buy cattle now. I can buy cattle. So leases, actually, if you go, for example, to most of the premises you are seeing along, for example, along the Namanga Road, even along Kiambu Road, most of those big properties you're seeing there, like restaurants being built there, they are built on leased land. They're built on leased land. And indeed, if you look at it in terms of wholesale, like now Nairobi, how many people have title deeds of their lands in Nairobi? Very few. Very few. Most of us, in this case, including where I've built my house, where I'm teaching you guys live from today, this is leased property. Leased property. It is under lease with who? With the Nairobi County government. You'll be told 99-year lease. So leasing is not a bad thing. It's one of those ways that, ladies and gentlemen, you shall always use to ensure that, it's like you're being given a loan. It's a form of a loan because the lessor is allowing you to pay for a property over a big, long time. A long time. Now, when you talk of IFRS 16, there are things you're supposed to know. These leased concept, there are things you're supposed to know. There are things you're supposed to know. There are things you're supposed to know. And I would want you to straight away go to your SBR book. There is this SBR book that I gave you, which I would want you to straight away open it up. And I would want us, I hope you remember this SBR. It's called Strategic Business Leader Book. Strategic Business Reporting. Strategic Business Reporting. That's how they call it in ACCA. That's how they call it in ACCA. All right. So I'm sharing it here. So you can see we have it here. So, ladies and gentlemen, what we are required to understand from your syllabus as well about this lease, we need to know, to identify a lease. We need to know how to do lessee accounting. We need to know how to do lessor accounting, like it came. There's a sitting in your past papers. You'll be able to see a question of Voxy. Voxy was the owner here. Voxy was the lessor. And then this examiner wanted you, for the very first time, you do what we call lessor accounting. So many students were not able to do lessor accounting because all of us teachers, we've been teaching lessee accounting. We must learn how to do the lessor accounting. Lessor is the owner, the one who is leasing and then we have sale and leaseback. Sale and leaseback is very, very common in your exams. And it is normally the easiest. When we talk of sale and leaseback, you're supposed to remember the case of Uchumi Supermarket, where there was some fraud. If you remember the case of Uchumi Supermarket, what happened with Uchumi Supermarket? We used to have Uchumi Supermarket having a very nice branch, which used actually to house its headquarters at Aga Khan Walk. If you know that branch there, Uchumi, Aga Khan Walk. Aga Khan Walk, we have an Uchumi branch there. Ladies and gentlemen, what happened in this case is that the directors, having realized that now they are getting into financial crisis, they sold that particular branch. They sold it. A lot of money, they sold it. All right. And then, of course, upon selling it, given that it was still housing its headquarters and it was the most profitable branch, they leased it back and continue doing business from that particular water premises for a very long time. So they did what we call sale and water leaseback. We normally go for the sale and leaseback transactions whenever we would want to do what here, open up our capital. If we realize that our capital, there is so much capital of ours that is tied up, what do we do to release that tied up capital? We can sell, and then we do what here? We lease back. Sell and lease back. So many, like now the Cork office in Kenya here, they did exactly that. They sold the building and then they leased and continued using it. All right. So sale and leaseback is a common thing. So our syllabus needs us to understand this concept of what here, sale and leaseback. But the very first thing that the examiner wants you to appreciate, and you'll be able to see in your past papers, are the definitions. The definitions. How do we define leases? Very, very important. All right, so ladies and gentlemen, here we are. So we are told here IFRS 16 leases provides the following definitions: that a lease is a contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration. So in this case here, we are giving you the right to use our asset for some specified time. All right. And at the end of the day, you must give us what we call consideration. Like, for example, RCM, we happen to be having some physical presence. And I'm so happy because of these online classes. Initially, RCM Stand Bank House, we used to have the whole of first floor. We used to have the whole of what here, seventh floor. I mean, we used to pay lots of rent, 800,000 a month, which we came and downsized. Actually, initially, during COVID, we were automatically chased out of that building because we could not be able to pay any rent. All right. So in this case here, now we have gone back there, RCM, Stand Bank, first floor. We simply took a small section, a small, very small section there, just to have what we call physical presence, because now most of our students are following us online. But now we needed some physical presence. What have we done? We've taken a lease. A lease. Why did we take a lease? Because there is no way we could afford building like that kind of a property in town. It's like a whole 1 billion. All right. Now, because we could not afford, we just went for a small section and a list. So in this case here, this person, upon leasing, he has given us what we call the right to use. He has given us what we call the right to use this asset, what we shall be abbreviating as ROU. He has given us the right to use that asset, that particular section of the asset. For what year? A specified period. A specified period, for a specified period. In town, most of the commercial properties, they give you a standard lease of 5 years, 3 months, a specified period. Now, ladies and gentlemen, I have one condition. For me to be able to continue having the right to use this asset, then we need to pay lease rentals. Lease rentals, lease rent. We need to pay the lease rentals. So I'm repeating again, ladies and gentlemen, this definition, what you're being told here is this. What we're being told here is this, that a lease is a contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for what year consideration. You must be paying the lease rentals. The lessor is the entity that provides the right to use the asset and in exchange receives consideration. So lessor is the landlord. Lessor is the landlord. The lessee is the entity that obtains use of the right of use asset and in exchange transfers consideration. They pay rent. Now, when you talk of a right of use, is the lessee's right to use an underlying asset over the lease term. Over the lease term. Now, ladies and gentlemen, please listen. For me, I can only talk of this as a lessee. This being an asset, because at the end of the day, the lease has to be booked as an asset in the books of the lessee. Remember, this is something that is quite important, IFRS 16, which makes me feel proud that when I walk in town, yes, I've leased an asset, I'm supposed to be a tenant, but in this case here, IFRS 16 tells me, so long as you've got a right of use, then that asset is as good as yours. You own that asset fully. All right. So the right of use automatically will be booked in your financial statements here as an asset, and you'll even depreciate it. But now remember, these guys must give us what we call right of what here? Right of use. So what if, for example, ladies and gentlemen, this thing is really morphing up to be a very serious thing. If, for example, I go in the morning, like today in the morning, and then I get my landlord having stood at the door telling me that this student cannot enter there, this student cannot, it means automatically then I'm not in control. then that asset, this thing is supposed to be a very serious thing that if the landlord even gets into my leased property, that automatically is trespass. Once I'm paying my or rather I'm paying my lease rentals nicely, and I have a lease contract, that particular premises is as good as what is as good as mine. So I have what we call the right of what here? The right of use. So I can only talk of right of use if I'm controlling, if I'm able to say that, fine, this is how I will use this particular what here, this particular property without interferences, without interferences, without interferences. Now, please listen. We are going to the identification of a lease. IFRS 16, leases, requires lessees to recognize an asset and a liability for all the leases. So if you go to the face of the financial statements of entities like, for example, RCM College, in terms of our leases, we shall be under the assets recognizing a leased, of course, asset under what we shall be calling ROU, right of use. And on the liability section, we shall be recognizing a lease liability. A lease liability. We are told here for all lease assets, unless they are short-term or of a minimal value. A minimal value. You see, ladies and gentlemen, if, for example, I'm leasing computers at RCM, yeah, remember leasing is, as I've told you, is going, or rather even today, is a big thing. Actually, we are required as a business optimization tool to lease most of our assets, lease them. So if, for example, you're leasing, say, for example, computers, what do you know about computers? Depending on the size of your company. Computers at RCM, I will call them low value assets. So if they are low value, then I will not call them leased assets really. All right. I cannot book them as assets in my statement of financial position. No. If they are low value, I'll simply be expensing them. As I pay those lease rentals, I simply take that as an expense. The same case in this case here, if the leased period is short term. Short term means less than a year, less than a year, less than a year. Then I can straight away say that, I mean, why should I start putting this leased item in my balance sheet as an asset, and yet I can't even depreciate? Because depreciation basically is supposed to be what here? Annualized. Annualized. Ladies and gentlemen, remember, initially, we used to have IFRS 16, all right? Or rather this list, IFRS, talking about what here, like operating leases, financing leases. It's no longer like that. Nowadays, you must book all leases in your statement of financial position, with an exception of what here? With an exception of low value assets, of which your company, you have to sit down and say, anything less than, for example, 5,000 shillings is low value. Leave it out of our statement of financial position. Or in this case here, short-term contracts, which are contracts with less than what here? 12 months or less than a year. Then those ones here, we can say, I mean, let's exclude these ones. But otherwise, all leased contracts here, ladies and gentlemen, have to be booked on the face of our statement of financial position as an asset. And at the same time, on the other side here, we have it as a what here? As a lease liability, as a lease liability. All right. Now then, ladies and gentlemen, we are being told something here. Now, this is very, very important. This is very, very important. A contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. If it conveys the right to control, the use of an identified asset for a period of what year? A period of time in exchange for what year? For consideration. The customer controls the asset's use if it has the right to substantially all of the identified assets' economic benefits, the right to substantially enjoy all of the identified assets' economic benefits, and then number two, the right to direct the identified assets use. Now, ladies and gentlemen, please listen. This is very, very important for us. Very, very important for us. Like now, RCM Online College, we own that small space at Stanbank. When students in this case here pay fees, this fees does not go to the landlord's account. In this case, it is RCM College Limited, which is able to enjoy all economic benefits. If, for example, I was to go there and put 300 students there, the landlord can't come and tell me, no, there is an overflow of students. Now, in this case, I'm coming to increase here my rent. All right, we are going to enjoy all the economic benefits of doing good business in that premises here. And of course, there is a risk that if, for example, I'm making losses, again, the landlord on that side of the coin will not want to know. And that is why I'm being called here to drive my business optimally in these leased assets. And then number two, ladies and gentlemen, a very, very important concept under the control here. Under the control here, very important concept is that we have the right to direct how the asset will be used. But now remember, even from your group consolidation, we shall be looking at group consolidation. We shall be looking at group consolidation later on, but we know that there is what we call control. That in this case here, we have a parent company. We have another company, for example, let's call it company B. So if, for example, we have majority of the shares of company B, which is 50% plus 1 shares, 50% plus 1 shares, 50% or over 50% shares, over 50% shares. So if you've got over 50% shares, we'll be told that we have, or rather we are controlling this B company. And if you are controlling it, then it's our company. It's part of us. It's sub. You know, sub means part. It's a subsidiary. Now, remember we are talking about that you have control of this asset. You can direct how you're going to use it. But remember, control is not supposed to be absolute. Control is not supposed to be absolute. You can't tell me that, for example, if I went, in this case here, with some tons and tons of bang to Stanbank House, and then I start selling, in this case here, this illicit substance over there, do you think the landlord can accept that simply because it's a leased asset, it's my asset within his bigger premises? Do you think he can allow me to do that? Do you think that is he can allow me to do that? Do you think he can allow me to do that? Somebody talk to me. So control is never absolute. It doesn't have to be 100%. All right. So long as in this case here, you can come and define, like, how do I legally, how do I do this and this legally, then that is good enough. But it can never be like this guy allows you to. No. Even you guys, you normally lease your vehicles. If somebody in this case here is to carry cocaine in your vehicle, automatically at the end of the day, these guys will not consider the lease contract. They'll come back to the owner of the asset. They'll come back. You really get yourself into quite a big mess in terms of what here, in terms of the law. All right, in terms of the law. All right. So again, in this case here, we are saying that you have the right of control, but you have to use this thing within the dictates of the law. Now, please listen. I'm driving towards something here. We are saying here, the right to direct the identified assets use. The right to direct the use of the asset can still exist if the lessor puts restrictions on its use within a contract, such as capping the maximum mileage of a vehicle or limiting which countries an asset can be used. These restrictions define the scope of a lessee's right of use rather than preventing them from directing the use. IFRS 16 says that a customer does not have the right to use an identified asset if the supplier has the practical ability to substitute the asset for an alternative and if it would be economically beneficial for them to do so. Ladies and gentlemen, please listen, and I want us to be very clear on this from the word go. If, for example, you've leased a vehicle to me, this is, for example, a Toyota Fielder, which I should be using, for example, for taking RCM publishers' books all over. You've given me a folder like that. And we have a lease contract. And then one of the fine days, you as the lessor, the owner of this vehicle, you come and tell me that, you know what? I have, for example, a birthday, whatever, and I would want to use this vehicle. I would want to use this vehicle on this particular day, and then I'm going to give you a different what? A different vehicle to use. All right. Of course, if it's one day, maybe you can discuss, you pay me even for that day you are taking back your vehicle, that's okay. But if you keep on doing that, the concept of substitution, then I don't have control over this asset totally. The concept of substitution, IFRS 16 says that if this asset can be substituted easily, if this guy can come and substitute, give you a different kind of an asset, then automatically that is not your asset. That is not, in this case here, conveying to you the right of exclusively using this asset as if you owned it 100%, as if you owned it 100%. Now, then, ladies and gentlemen, to me, the most important thing under this is to show you guys how do we recognize this right of use? How do we recognize these liabilities in our books of accounts? That is what I want to teach you this morning. Now, listen and listen to me very well. Listen and listen to me very well. Listen and listen to me very well. Mention there, recognition of lease liability. Recognition of lease liability. Recognition of lease liability in the statement of financial position. Now, ladies and gentlemen, listen and listen to me very well. Listen and listen to me very well. The person who has given RCM College the space at Standbank House first floor knows for sure that there is no way we can afford it. Remember the law. The law needs you to pay like the entire lease rental for those 5 years. You're supposed to pay. Actually, whenever you default on your lease rentals, if you're taken to court, if you never knew this, you should know it today. If you're taken to court, normally the owner of that leased space would claim the total rent for the 5 years, for the leased period, total rent. And this is something that I've seen practically. I used to be the principal of Orbit School of Management. Orbit School of Management had hired Bank of India. It was a 10-year lease. Unfortunately, I think because of the place is prime and the students were not coming as fast as we had thought. And we had, I think we also stipulated, because we used to have some premises at Agriculture House, which was quite close. All right. We don't know even why we were going for a second property. So 2 years down the line, we defaulted on lease rentals, and this guy took us to court. Of course, I was a director, I was just the principal. In this case here, Orbit had to pay the lease in full. And that space, if you remember, was left vacant for a very long time. Of course, there were discounts here and there, but at the end of the day, they paid the whole term. But now, ladies and gentlemen, please listen. Listen and listen to me very well. Not many of us, why am I going for a lease if I would have afforded to pay the entire liability? No. We are going for a lease because of this thing of what here, bottoms up. They would want to give you an opportunity to build yourself up as an entrepreneur. You build your muscle up until you reach a level now where we are able to build our own Standbank house like that after, say, a number of years. So at the end of the day, then we shall be paying like what we call monthly lease rentals. So you'll be told, for example, to be paying like, say, 10,000 Kenya shillings every month. All right. So then the very first thing you're supposed to do, you as an accountant now, whenever you're told that there is a leased property, ask for lease rentals. How much are you supposed to be paying? Like 1 million shillings every what year? Every year. For how many years? For 10 years. Then what do? You discount. So in this case, ladies and gentlemen, IFRS 16 requires us to ascertain what we call the present value. So in this case here, we must ascertain ascertain the total present value of the lease rentals, lease rentals, lease rentals, lease rentals. So ascertain the total present value. Please write this in full. Total present value of the lease rentals. That is the first thing that you do. I don't know how, I don't know. Are we doing all of us, are we doing AFM this semester? Are we able to remember like this concept of discounting, all of us? Like we've got two types of cash flows. We have what we call the annuity. We have what we call the irregular cash flows. Or would you want Mwalimu to remind you? Are we doing AFM, all of us, this semester? Oh, okay. Oh, okay. Okay. So then I'm going to take a few minutes. I can see, no, PVF and PVF. I'll take just 2-3 minutes to remind you guys something small on discounting of cash flow. So mention there just a small subtitle, discounting of cash flows. Discounting of cash flows. Discounting of cash flows, very few minutes. Discounting of cash flows, like that. So tell us whether there are two types of cash flows. There are two types of cash flows. There are two types of cash flows. Number one, we have irregular cash flows. Irregular cash flows. So irregular cash flows, please, we shall use what we call PVF to discount. Use PVF to discount. Irregular cash flows, we shall use PVF to discount. You can write here, use PVF to discount. Remember, PVF stands for what here, somebody? Present value, interest factor. Present value, interest factor. So irregular cash flows are those cash flows that you will get, for example, 10 million this year. Next year, you get 15 million. Another, you get 8 million. So the cash flows are irregular. The cash flows are irregular. The cash flows are irregular. And if that is the case, then we shall always use what we call PVF. So, and the PVF formula is very, very easy. PVF formula. PVF formula is 1 plus R raised to negative who? Raised to negative N. 1 plus R raised to negative N. That is the PVF formula. That is the PVF formula. PVF formula. 1 plus R. R is the return. The required return, the cost of capital, 1 plus R raised to negative N. Remember, in AFR, you must cram those formulas because you'll not be given the formulas and you'll not be given the discounting tables. In AFR, you must cram those formulas. So then I would want to give you an example. So mention there example. So example. So PVF equals 1 plus R raised to negative N, of course, is the period, the number of year, the year number. Example. So example, we have here example. We have Becky Limited. So we have Becky Limited's cash flows. We have year 1, year 2, year 3. So Becky has the following cash flows. Becky is a rich lady in shillings millions. So this could be 11, this could be 13, this could be 15, and then we have cost of capital. Cost of capital is 10%. So we are required here to determine Becky's total present value. Becky's total present value. So cost of capital is 10%. 10% is our R, our return. 10% is our R. So Becky is doing some business here, and the cash flows, you can see the cash flows are fluctuating. The cash flows are irregular. And if they're irregular like that, ladies and gentlemen, then you are required to determine Becky's total present value. Becky's total present value. So if you allow me, ladies and gentlemen, I will be able to proceed. But before I proceed, if you've been able to write up to here, are you able to put your thumbs up like this, live? Your thumbs up like this, live. Your thumbs up like this, live. Are you able to put your thumbs up live for me to continue? All right. 2 weeks ago, I don't know. Okay, great. So in this case here, determine Becky's total present value. So the total present value for Becky here, what I'll do for lack of space, abracadabra, will come and grab this, and then I'll create, because the cash flows are fluctuating, I'll create a column here for PVIF, which is 1 plus R raised to negative N, like that. 1 plus R raised to negative N. So what is our R? Our R, ladies and gentlemen, here is 10%. You see, 10% is the same as 0.1. 10% is the same as 0.1. I can see Juliana is raising her hand up. Juliana, would you want to talk to us? Let me ask you to unmute. Oh, umeka mkono chini mbio. Wow, okay. We shall overcome, Juliana. Thank you. So in this case here, R is 0.1, abracadabra. I'm using this formula, so this will be 1 plus 0.1, oh yeah. 1 plus 0.1, oh yeah. 1 plus 0.1, oh yeah, raised to negative N. You see, N is the year number. So in this case here, raised to negative 1, raised to negative 2, raised to negative 3. So is there somebody who is able to give us these figures very fast? 4 decimal places, 4 decimal places, 4 decimal places. I'm moving pretty fast, but should you feel that the speed is very high, please let me know, because I'm not supposed to teach you this here. This is supposed to be taught to you guys at the lower level. 1991, 1991, 1991. I hope everybody knows how to raise. You'll say 1.1, then there is a raised function. There is a raised function in your calculator like this. So 1.1 raised to minus 1. All right. And then we have here 1.1 raised to minus 2. 1.1 raised to minus 2. 1.1 raised to minus 2. 1991 vero uongo. Uongo, uongo. Tushamaliza na hii vero. Uongo. 8264. 8264, 8264. And then lastly, we have 1.1 raised to negative 3. 75, 75, 13. 75, 13. 75, 13. So please come and create a column here for present value. Create a column there for present value. Create a column there for present value. How do we get this present value? We are taking the cash flows times the PVIF. To get the present value, we are taking the cash flows times PVIF. That's how we are getting this present value. So like 2 decimal places. Remember, for PVIF, 2 decimal places, PVIF, 2 decimal, 11 times this, according to Ngera, it is 10. So according to Ngera, the first one is 10. How about the second one? This 13 times this figure, 2 decimal places, 10.74. That is Susan Irongo. Susan Irongo. Susan Irongo is this lady, I think, who sold to me a very good watch, very nice watch. If you want the best watches, very affordable. Atakuzia saa mzuri sana, if I'm not wrong. Hii majina inafanana sana. 11.27. 11.27. So abracadabra, now that you've been able to discount them, now you'll be able to come under sum. So please come under sum. Please come under sum. Una add zote Lease. Lease has a very good name. Una add zote. Inakuja 32 point what here? 32.01. 32.01. 2.01. So whenever you are given lease rentals, like now this could be the lease rentals, you must discount them to get what we call present value. You must discount them to get what we call present value. So up to here, are we really together? Please ensure that when you see that I'm moving beyond your speed, tell me stop. But if you are able to follow somehow, I would request that you allow me to move, because you see, at the end of the day, this was not part of my program. All right, they're saying like this. They're saying like this. All right. Now from there, we have 2 types of cash flows. These are irregular, non-uniform, very, very important. And then now we have what we call number 2. Number 2, now we have the regular, the uniform. Number 2, now we have the regular, or what we call the uniform. Regular, uniform. Cheriot, great. Cheriot anasema ngumi namna, very good. So number 2, we have what we call the regular or the uniform. So number 2, we have regular or uniform. Regular or uniform. Regular or uniform. All right. So remember regular, ladies and gentlemen, basically we have like 10, 10, 10, 10, 10, 10. So like now here, we have here year 1, year 2, year 3. So then we have our cash flows. So we have our cash flows. For example, year 1, we are getting 10, year 2, we are getting 10, year 2, we are getting, year 3, we are getting 10. And then assuming that R is 10%, R is 10%, I would want someone to come and give me PVIF. PVIF. Assuming you don't know what PVIF is. Assuming you don't know what PVIF is, come and give me the PVIF. What happened here, really? What happened there? Give me the PVIF, assuming you don't know what PVIF is. So I want to treat this as if they're independent cash flows, as if they're independent cash flows. So PVIF is 1 plus R raised to negative N. So still this will be, you see 1 plus 0.1. This will be 1.1 raised to negative 1, 1.1 raised to negative 2, 1.1 raised to negative 3, like that. So this one, somebody has been able to tell me it is 0.1991. All right. How about the second one? How about the second one? I'm assuming, ladies and gentlemen, that fine, they are regular, but let me treat them as if they're independent. 8264, 8264, 8264. And then lastly, we have 75 something, isn't it? We are copying the figures that we got up there with 10%. 7513, 7513, 7513. So then can you kindly come and create a column here for present value? For present value. Remember, present value, you are taking your cash flows multiplied by the PVIF. There must be a problem here. This thing is switching off itself. It's switching off itself. There must be a problem here. We shall overcome. So now you're multiplying. So you're taking this times this. Allow me to write this in many decimal places. So this will be 9.091. This will be 8.264. 8.264. 8.264. And then lastly, we have this and this, giving us 7.513. So up to here, I don't know whether we are together. Up to there, are we together really? Are we together up to here? Of course, I know most of you, like Paul there, they're trying to talk about what here? They're trying to talk about the PV. I'm assuming that we don't know. I'm assuming that we don't know. I am assuming that we don't know. I'm recording it on Facebook. I'll be able to download it later and then I put it in the LMS. All right. All right. I don't know what the problem is. There is a slight problem there. My video is going off every time. So, ladies and gentlemen, are you able to give me the total present value? Is there somebody who can give me the total present value? Is there anybody who can give me the total present value? Is there anybody who can give me the total present value? Total present value is 24 point something, right? Total present value is 24.867. 24.86. 24.868 or 7. 8 like that. Thank you so much. Thank you so much. But you see now there is one problem. There is one big problem. Whenever it's an annuity, the examiner will tell you that this 10 is receivable every year for 50 years. For 50 years. So then if it's for 50 years, it will be very cumbersome. It will be very cumbersome. And that is why, please mark this, that is why some people sat down and said, no, we must come up with an easier way of getting this total without going through these figures individually, without going through the figures individually. And this is now what led to what we call for regular cash flows. For regular cash flows, you should never be doing it this way. This is an old man's way of doing it. Old man's way of doing it. For regular cash flow, we shall always be using what we call PVFA to discount. So for regular cash flows, you use PVFA to discount. PVFA. Use PVFA to discount it. And PVFA is what we call present value, interest factor, present value, interest factor of an annuity. present value interest factor of an annuity, because regular is annualized, is an annuity, is an annuity. And how do I remember this formula? So long as I'm able to remember the PV formula, if I'm able to remember the PV formula, then I'm at home. So long as I'm able to remember the PV formula, PV is 1 plus R raised to negative N. That is PV. So long as I'm able to remember PV formula, I'm at home with PV. Because anytime they want me to give them PV, anytime they want me to give them, it will be 1 minus the PV formula. 1 minus the PV formula. And PV formula is 1 plus R raised to negative N. And then I divide everything with R. So anytime, ladies and gentlemen, they want me to get the formula of PV. So long as I'm able to remember the PV, so long as I'm able to remember the PV, then I'm at home, because PV formula is like this. And therefore, to get PV, I'm taking 1 minus the PV formula, and then everything to be divided by what here? By R. Everything got to be divided by R. Everything to be divided by R. Everything to be divided by R. So then I would want us to take this opportunity to calculate the PV for the question that Mwalimu rubbed above. The PV for the question that Mwalimu rubbed above. So PV, remember R was 10%, N was 3. So PV will be equal to 1 minus 1 plus 0.1 raised to negative 3. And then everything to be divided by 0.1. So please go ahead and get the numerator. Go ahead and get the numerator. Go ahead and get everybody should be able to get this numerator. You say 1 minus 1.1 raised to minus 3, and then you give me the numerator. Give me the numerator. Everybody should be able to write that answer down there. Everybody. Because you can't, denominator computation comes later. So you say 1 minus 1.1, and then we have a raised to. Raised to looks like this, raised to negative 3, and then you say equals. Once you say equals, whatever answer you get, make Lease. This was your question, make Lease, and I can't see you giving me an answer. Whatever you get there, you divide by 0.1. Whatever you get there, you divide by 0.1. Whatever you get there, you divide by 0.1. Juliana, thank you. 2 points. So the final answer they're telling me is 2.4 something. The final answer they're telling me it is 2.4867. 2.4867, like that. That is the final answer for PV. That is the final answer for, thanks, Dan. That's very good of you. So you must always endeavor to give me answers here. And therefore the total present value, the total present value will be, remember, Lease was getting 10 every year. The annuity cash flow was 10 every year. So you take this 10 now times PV, 10 times PV that you have obtained. So you take the annuity cash flow, you simply take one annuity cash flow. You don't take like 10, 10, 10, 10, no. One representative annuity cash flow. So now with that 10, you multiply it with the PV that you guys have just given me. So in that case, then what do we have here? We have 10 times this PV of 2.4867, which will end up giving me 24.867, like that. So does this answer resemble some answer we got using the archaic, ancient, old method? Does this answer resemble? Does it resemble some? Yes, apart from, of course, the fact that one had 8 here, but you see those are rounding off errors. Those are rounding off errors. Those are rounding off errors. So, ladies and gentlemen, if you go to an exam, I would want to be very categorical here. If you go to an exam and then you realize you are told here, if you go to an exam and then you realize here that you're told as an exercise, you're told here as an exercise, you're told something very nice here, that Paul Limited expects to receive Kenya shillings 50 million per annum for 4 years. And then we have the cork is 12%. The cork is 12%. So we are required here to determine Paul's total present value. Paul's total present value. Let me give you a minute. You try this. So Paul Limited expects to receive every year Kenya shillings 50 million. Kenya shillings 50 million every year. For how many years? For 4 years. And then Cork is cost of capital. Cost of capital is 12%. So we are required here to determine Paul's total present value. We are required here to determine Paul's total present value. Paul's total present value. Is there somebody who thinks they can easily do this for us? The moment they mention 50 million per annum, something in this case here called annuity comes to my mind. Thanks, Becky Lease. Thanks, Ngera. This comes to my mind right away. It's an annuity, and therefore, calculation of PVFA is not debatable. I will calculate PVFA, present value interest factor of an annuity. Present value interest factor of an annuity. Present value interest factor of an annuity that has to be calculated. And how do I get PVFA? I know PV formula. The moment I remember PV formula, if I'm able to remember PV formula, which is 1 plus R raised to negative n, then getting PVFA will be a walk in the park. It will be 1 minus the PV formula, which is 1 plus R raised to negative n. And then everything divided by what here? Everything divided by R. Thank you so much. So R is 12%. R is 12%. R is 12%. 12% is the same as 0.12. 12% is the same as 0.12. So therefore, this will be 1 minus 1 plus 0.12 raised to negative n. Here we are talking about 4 years that Paul will be receiving this 50 million. And then everything to be divided by R, which is 0.12. Where people mess, it is in the numerator. The moment you're able to get the numerator nicely, the moment you're able to see where raised is, we have raised is like this, raised is like that. So you say 1 minus, open brackets, 1 plus 0.12, you close, and then you raise, negative 4. Then whatever answer you get, after you said equals, you come and divide this by 0.12. Dorothy Mbabu is giving me 151.84. 151.8 something, 151.87. 151.87. So all of us, are we comfortable with this? Are we comfortable with this? At least I've been able to take a few minutes to just show you guys how we discount. Because I need discounting in all these IFRSs, you'll be surprised. In most of them, not all. In most of them, we need discounting. We need discounting in most of them. And then if you allow me, then I'll be able to take you now to the leasing question. So mention their example, mention their example. My aim is to finish, but I can't finish this really today. I cannot. It's too much. It's too much. Given that I've taken like 30 minutes to this discounting, I can't finish this. And I mean, so example. So we have here a lease, example on lease. So we have a 3-year lease term, a 3-year lease term, annual lease rentals, in arrears, Kenya shillings 5,000. Hii lazima itakuwa kama nyumba ya kuku tu. Sini pesa kidogo sana. Ni kama nyumba ya kuku umelis. The cost of capital is 12.04%, 12.04%. So we are required to prepare financial statement extracts in the books of the lessee, in the books of the lessee. in the books of the lessee, in the books of the lessee, in the books of the lessee, in the books of the lessee. So it's a 3-year lease term. Annual lease rental in arrears is Kenya shillings 5,000. Cost of capital is 12.04%. Prepare financial statement extracts in the books of the lessee. The lessee. Lessee is the tenant, remember. Lessee is the tenant. Lessee is the tenant. Lessee is the tenant, if I may use this term for us to appreciate. So in the books of the lessee, the very first thing that I will do is to calculate the present value of the lease liability. Because the lessee is liable to pay rent. And has been told in this case here to be paying 5,000. For how many years? For 3 years. And there is cost of capital there. And of course, I've never seen lease questions where, cash flows are irregular. Our cash flows here will be regular. There will be annuities. There will be annuities. There will be annuities. The only thing that you have to be very careful, you see, like now, this is being paid in arrears, end of the year. In some cases, they may tell you that the lease rentals are payable in advance, which is the practical thing. Ile nyumba tunaishi, huwa tunalipa rent in arrears ama in advance. Unalipanga rent in arrears ama in advance. Hatukuja uishi, ulipe. Unalipa, uishi. Unalipa, uishi. So it is rent in advance. It is rent in advance. It's rent in advance. All right. So then what I expect to see, ladies and gentlemen, is a discounting of this 5,000. That's a free mark. Discounting of this 5,000, which is a free mark really. Which is a free mark really. Discounting of the 5,000, which is a free mark, which is a free mark. All right. So then, ladies and gentlemen, we have here total present value. So total lease liability. Total lease liability is equal to total present value. So the total present value will be the 5,000 that is being paid on an yearly basis, multiplied by PV for 3 years, 12.04% cost of capital. Remember, this cost of capital, which is our R, is the same as 0.1204. If I put it in form of decimal. And then remember that our PV formula is 1 minus 1 plus R raised to negative n divided by R. So then this one here, I can see already somebody, Pauliam. I'll be calling you Paul. Paul is easier, it's better. All right. So then this will be 1 minus 1 plus 0.1204 raised to negative 3, and then everything to be divided by R, which is 0.1204. Please, hapa tuende pole pole. Pata numerator ikiwa kando. Whatever answer you get kwa numerator, divide by R, which is 0.1204. 0.1204. Pata numerator kando, alafu divide by 0.1204. How I wish I was seated next to you there in your home. Because I would want to see whether everybody is good in how they're using their calculators. Because now I know there are ninjas who are not punching anything. There must be a ninja somewhere who does not even have a calculator. And then later on, they'll be disturbing us. Please ensure that you buy a calculator. Don't rely on your phone's calculator. Is there any ninja? Be very honest. It's good to be very honest with Mwalimu. Is there any ninja who is using their phone's calculator here today, this morning? Is there any ninja who is using their phone as a calculator? Please be very honest with me, Mwalimu. I'm your father here. You must be honest with me. Rahel. Okay. We shall overcome. So in this case here, ladies and gentlemen, they're telling me They're giving me some value here, but nobody has given me this value really. Nobody has given me this value. What value are you getting here? Is it 1 point something, 2 point something? This one here, the whole of this. The whole of this, what value are you getting? I know you're giving me the final answer, but I don't want the final answer here. I want this figure alone. I want this figure alone. 2.4001. 2.4001. Is that correct? 2.4002. They're telling me more limit is 2.4002. Let's be very, very accurate like that. And then now come back here and give us the total present value. Give us the total present value. Give us the total present value. So total present value will be equal to the figure here, which is 5,000 here, times the PV for which is 2.4002, like that. All right, which then in this case here will end up giving me what figure at the end of the day? Is there somebody who is able to give me the total present value? So we have 5,000 times that figure that you have gotten there, which is 12,000.9. 12,000.9, 12,000.9. Why don't we talk of 12,001? I think that will make more sense. 12,001. Ah, Godfrey, yes, 12,001 will make more sense. Will make more sense. Will make more sense. Now, ladies and gentlemen, once you've done that, what do? We shall recognize an asset and a liability at the same time. At the same time. So in this case here, we shall come here and debit what we call a leased asset. Leased asset, but remember, we don't call it leased asset in our statement of financial position. We shall call it the right of use. The right of use, ROU, you write in full, right of use. And then you credit leased or lease liability, lease liability, lease liability, lease liability. So we have here 12,001 and then 12,001, like that. That is the first thing you do. You pass after you get the present value. After you get the present value of the liability, remember you're going to have the two sides of the coin. One side of the coin tells you this thing is an asset, it's your asset. Another side of the coin tells you have not paid for this asset in full. You shall be paying small, small, small. So you have a lease liability. You have a lease liability. That's the first thing you do. You get, first of all, the liability. You book in a journal. And then from there, remember now you have an asset. The next thing you'll do is to come here and calculate depreciation per annum. So depreciation per annum, of which IFRS 16 recommends straight line method. Straight line method. So in this case here, your asset is here. It is 12,001, and you're going to depreciate this over 3 years evenly. So you depreciate like that. You depreciate. So we have 12,001 divided by 3. So that gives us what figure? That gives us what figure? That gives us what figure? Abracadabra. About 4,000, isn't it? About 4,000 every year. So 4,000. So then you have taken care of this. You've taken care of that. You've taken care of that asset. I'll be still showing this in the face of the statement of financial position, but I'm just taking you through the procedures. And the last procedure I would want to do today now is on this. This lease liability is a loan. Remember, it's a loan that the lessor, that the landlord has given you. So you must make for us what we call a loan amortization schedule. So here you calculate depreciation for this, but here you prepare a loan amortization schedule. You prepare a loan amortization schedule. Is there anybody who remembers how to do a loan amortization schedule from your FM? Level 3, level 2, I mean, intermediate level. Is there anybody who is able to remember how we do a loan amortization schedule? Is there anybody who is able to remember how we do a loan amortization schedule? Wow, great. You guys are geniuses. Great. At least I have one guy called Ngera, who is able to tell me that, Mwalimu, you know what? Yes. Ruth Nyambura, no. Good. I like students also who have a thick skin who will be able to come and tell me, Mwalimu, I'm not a pretender. If I don't know, I don't know. I'll always say, I don't know. And then we do it. We do it. We do it. So a loan amortization schedule. So come and give us a loan amortization schedule. Come here and give us a loan amortization schedule. Because I mean, this guy is giving you a loan. So come and give us, because of the loan aspect, give us a loan amortization schedule. A loan amortization schedule. So loan amortization schedule, you should always have here the time, the year. So 1, 2, 3. And then we have in this case here opening balance. We have opening balance. We have, ladies and gentlemen, in this case here, the interest. We have the interest. And then we have amount paid. And then we have closing balance. All right. So can somebody in this case here, first of all, confirm that you have been able to put down this skeleton of a structure down? Before I start posting, it will be important for us to, first of all, acknowledge the fact that we are together in terms of having drawn this. Have we drawn this? And here I'm addressing you ladies. I know you are very neat, but please don't make it a habit like of using a ruler throughout. There are things in this case here we need to also just do them freehand. To be very honest again here, my great ladies around in my class, is there any lady who is using a ruler to draw this? Because you are smart, ladies and gentlemen. Yes, you're smart and you're not shying away from that fact. You're using a ruler. Ukitaka kujinyonga mwalimu jinyonge. No, I'm not against it. I simply want us to move with speed. Neatness is a virtue. It's even required in the Bible. Neat work, yes. All right. So then what is the opening balance of our loan? Can somebody give me this answer? 12,001. The total present value of the liability. 12,001. Like that. All right. Do we know the interest percentage? Or yes, the COC. The cost of capital, which was 12.04%. By the way, the amount paid here, we have 5,000. This is normally constant. This person will be paying 5,000. Like that. Those are the amounts paid. And then, of course, the closing balance at the end, even if it doesn't amortize fully, we expect that one to be 0 and it shall be written in advance. Even if I get something different, I can't change this. This must always be 0. This must always be 0. I'm giving you secrets, right? All right, great. So then can you kindly give me, so 12,001, so there is interest of 12.04%. Can somebody take this times this? Give me an answer here. Kindly give me an answer here. Interest 1444.8. Please here give me 2 decimal places. If possible. Give me 2 decimal places. 0.92, is it 0.92 or 0.8? No, use this exactly, 12.04 times this. This is okay. And then I'll come and give me the closing balance. So how do I get the closing balance? I will take the opening balance, add the interest to this, and then you subtract what he paid. So you take this plus this, you subtract this, give me the closing balance. So what do we have here? Closing balance. So you take the opening balance, you add interest, you subtract what he paid in the year. 8445.8. 8445.8. This is the figure that we bring here as the opening balance in year 2. So opening balance in year 2, Juliana, it is 8445.8. And then you come and give us the interest, isn't it? You give us the interest. So you take this times this. What interest amount do we have? What interest amount do we have there? Year 2 interest is 1016.87. This Ingera man is a good man. Leonida, thank you very much. 8445.8 is the opening balance for year 2, which you bring forward here, isn't it? And then what is the interest for year 2? So the interest will be 12.04% times what was brought down here. Times what was brought down there. They're saying it's supposed to be 9.2, eh? I don't know who's telling me the truth. I don't know who's telling me the truth. Let me work with this because I can see most ladies are saying 0.92. Most ladies are very nice. Men, we are also nice, but we, at times, we are not very keen. 0.92. All right. Then please subject this to the interest. Give me the interest amount. Give me the interest amount. Give me the interest amount. Interest amount. Interest amount. Give me the interest amount. And I need to run away. Today is Monday. Monday, we have quite a lot at the office. So 1016, 1016.89, 1016.89. So then we have this plus this minus 5,000. This plus this minus 5,000, which gives me what amount there as the closing? According to Joanne, it's 4462, 4462, 4462.81, 4462.81. This is what I bring here, 4462.81. So subject this to the interest rate to give me the interest amount. To give me the interest amount, 537, 537, 537.32.32. So please take this plus this minus 5,000. Joanne, I know ladies are very honest, but please don't also be very honest at times. Don't be very honest at times. There are times in this case here that kind of cheating, professional cheating, also helps. If you got 0.13, do you write 0.13 and then you show your examiner that it never amortized to 0? Do you write 0.13 and then you show your examiner that it never amortized to 0? No. You write what there? 0. You write 0 like that. You write 0. We know that the 0.13 is because of what here? Rounding off. So when we come to our next session, which will be tomorrow, so I'll be able to show you that in the income statement, this is what will be taking the income statement as interest. So income statement will be taking two things. You'll be taking the interest you're going to be paying, and you're going to be taking the depreciation. So in the income statement, depreciation for each year and interest. And then, of course, in the statement of financial position, we're going to see how you'll take this as an asset. And we're going to be dividing this into two, non-current assets and current assets. That I'll be able to do in our tomorrow's class. Otherwise, it has been an interesting session in the morning. We look forward to doing better things. And don't forget to go and do some 1 or 2 exercises from your SACA book. As I told you, that SACA book is a very important book. Thank you and bye. Bye. 0.13 silent, yes. Be blessed in area 2. Bye-bye.